Hope everyone out there is having a good day so far.
Fast got 33% for May the 13th, unchanged from May the 10th.
Going to be a pretty interesting trading day, I have a feeling. Going to be a pretty interesting trading day, I have a feeling. Oh, look, we got a bit of echo. Let's take care of that.
ECB's Wunsch says high rates for longer by the Fed might lead to a slower pace of ECB rate cuts, saying the first 50 basis points of rate cuts close to a no-brainer, saying we should proceed gradually, refraining from committing to a second rate cut in July.
All right, folks, welcome to Back to the Futures with me, Markets and Mayhem. We're going to have some fun today. We're going to talk about what all is going on with these crazy markets and meme stocks and everything else. But first, let's get through everyone's favorite part of the presentation. I know this is why you all really tune in. It's when I read the disclaimer. All Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. All right, we've got that part out of the way. So y'all can tune out now because we did the favorite part, right? But no, in all seriousness, a little bit more about me. My real trading journey began in 2005, funding my own account and trading stocks, then moving on to options, futures, and Forex. I did some trading during the dot-com bubble, but it wasn't my money. It was money I borrowed from my dad against money I had earned working, and I was too young to be able to do my own trading. So I don't really consider that the beginning. But an interesting story of that is that and it's really relevant to today, given what you're seeing with GameStop and AMC. So I'll just share it. I bought Amazon. I bought Yahoo with those funds I had borrowed, right? They both nearly doubled the next day. That was the mania that was going on at the time. And in my young mind, I said, that doesn't make any sense because you know what? If you could do that, why would anyone work? You could just go to the bank, borrow some money, buy some stocks, they double the next day, and you're done. You know, like what would you need to do anything for? So I sold it. Like I got right out. I told my dad, close the positions, pay me the difference versus what I owe you, and I'm done. And I spent the next several years learning more about markets because I just didn't really have a good appreciation for how those mechanics were something that was sustainable. And of course, as the years went on, I learned they weren't. The dot-com bubble busted. And that was that. And that gave me a good appreciation for what euphoria looks like on the way up and what the death spiral of all that extended positioning can look like on the way down. Now, that's not where we are now. We're not in the heights of the dot-com mania, but we are seeing euphoria in some of these meme stocks like GME and AMC. And if you're making money on it, that's awesome. Just be aware that there is some chance that this stuff can turn against you pretty rapidly. So, don't be hesitant to book gains where you see them. That would be my one thing that I learned back then that I still keep in the back of my head. Book profits, wherever you can. Quite frankly, on moves like this that are extraordinary and aren't really backed by the positioning in the stocks. The short interest is much lower. And I know there are folks that are saying, oh, but there's swaps and derivatives and other things. Ultimately, they still have to short the shares. Even these synthetic products have some kind of indirect exposure. And if it's all options driven, the market makers have to hedge somewhere, which is going to be in the shares. It's going to show up. Now is not like then. So at any rate, I navigated through the great financial crisis, which helped me to better appreciate the importance of understanding intermarket dynamics. Because, a lot of stuff fell apart during the great financial crisis. It was pretty remarkable. Like there were days you'd get up and things would be basically bidless. Right? You just sort of like get up and be like, oh, look, Microsoft doesn't really have a bid. Exxon doesn't really have a bid. That seems fine. And then you get an intervention from the Fed, maybe an emergency 50 bips cut, and the market would pop back higher like nothing even happened. Everything would soar up 3, 4, 5%. So, just be aware that what we may be looking at any given moment, if something comes in and changes the rules of the game, a lot can happen very quickly. This often happens during downturns, right? So people get really, really bearish. They think it's the end of the world. They want to sell their whole portfolio. But that's not really a good idea. If you're a long-term investor, it makes a lot more sense to just weather the storm. Especially if you're in index funds or well-managed active funds. Obviously in single stocks, that's a different story. It depends on the strength of the company. Now, my approach is systematic. I trade driven by momentum, price action, option flows, volume profile, and the big picture. Macro and momentum, to me, equal opportunity when they both agree. It's fine to have a macro thesis, but if the momentum doesn't agree with the macro thesis, I'm not taking the trade because, you know, other players aren't seeing it either. And I do want to have some validation by the market. I'd rather be a little late and on the right side of the momentum than early and getting hurt. So I began working with Bookmap in early 2022 because I saw great value in the way their platform displays market data, and we'll be getting into that shortly, including the heat map, iceberg stops, and more. And then I built a tool to add into Bookmap, my advanced SPX options visualizer, to better show how options impact price. And we'll talk about that and demonstrate it as well. Now, if you'd like to follow my work, you can follow my posts on Twitter and videos on YouTube at Mayhem 4 Markets. That's Mayhem number 4 Markets. My trading ideas, coaching, and unique market tools can be found at TraderAid.com. You can get up to 40% off of Bookmap at TraderAid.com/Bookmap. And the advanced SPX options visualizer is now available on the Bookmap marketplace, TraderAid.com/SPX, to learn more about it. My long-term trading and investing ideas, research, and institutional consulting services are available at macrovisor.com. And you're here, so you know it. I live stream regularly for Bookmap, and I live stream on my own as well every Tuesday at 9 a.m. for Bookmap, however. So you're here. Let's have fun. Join me weekly. And that brings us to where we're going to dive right into Bookmap today. So here we are, right on screen. And folks, while I'm doing this, if you have any questions about anything, please don't hesitate to chime in. I do want to make sure that, you know, folks out there that want to learn more about how Bookmap works in particular, or what they're seeing on the screen, if they have questions, that they get those questions answered. Just like if you have questions about how I'm using Bookmap, or, you know, what I'm talking about, please don't hesitate to ask. This is all a lot of fun for me. I really enjoy teaching just as much as I enjoy learning, and I think we're all well served to be perpetual students of the markets. So earlier this morning, we had PPI. Now I want to show you guys some stuff here with this, okay? This is meant to be just sort of like education about the risks of event trading. There's nothing wrong with trading events as long as you know what you're doing, but if you don't, you can get real hurt. So what do you see here? You see just a sort of slow sideways chop amid a lot of liquidity, right? The order book is nice and thick. There's plenty of bids and offers, no worries. Right before PPI, what happens? Like, and we're talking about like 2 minutes before, all that liquidity disappeared. So what does that mean to you as a trader? It means if you're trying to get out of something, you're going to have a tough time at the price you may expect, because there's just such sporadic liquidity. The whole order book dried up. And then once the event happened, you had this huge gap down, right? So if you were long into PPI, that probably hurt, and you probably got stopped out even though the market came back. So this is why you got to be kind of careful about this. Now the liquidity's back on the order book. You could see it took a while. It wasn't just right after PPI that everything came back. It's about 12 minutes later. All right, so now we're back to a pretty decent order book, depth of about 52,000 contracts on ES pre-market. We've seen top of order book liquidity improve a lot over the last couple of weeks. So that's a good thing. We're also back in positive gamma territory. That helps to stabilize things just a little bit. You're more likely to see dips bought and rips sold. Our TraderAid Naive Gamma Calculator model updates this stuff every minute. You can always check it out. But this is something that kind of adds to this environment of during normal trading hours, not pre-market where it's a little less liquid, but during normal trading hours, nice order book depth, decent, you know, top of book order book liquidity combined with positive gamma territory tends to be a stabilizing force for the market, and it tends to be pretty constructive. Someone asked, dude, I see this in the NASDAQ too. I mean, I'm going to imagine it happened in every index, right? Here you go. There's the NASDAQ, same exact gap down. All the liquidity disappeared. You had this big move lower, you know, and then you had the push back up. And so lots of stops probably got pushed out from smaller traders during this run. This is why trading those events, you just want to be a little bit careful. Like maybe you were really nimble and you're able to buy that dip. That's great. But on the other side of it, if you were like long into this thinking, oh, cool, PPI, that's the narrative, everything's going to be fine, you know, you probably got hurt. So for me personally, I don't tend to like to trade events. I like to trade the reaction a little bit more than the event itself. And on a day like today, I'm going to wait till the market opens. I'm going to look for the 20-minute opening range. I'm going to see how big that range is, because the size of the opening range is going to give you a sense as to how much of a move you might get after any kind of break, right? So that's going to be part of how I factor it. And then if we get a break one way or the other, if we get a break out of the opening range to the upside, and it's a decent sized opening range, which implies a decent sized move ahead, I might be more inclined to take it. There is one big caveat to all of this. That caveat is, it is OPEX week. That does mean that there's going to be some more price agnostic players moving positions around. And that portends to a market that may not necessarily have some of those same probabilistic outcomes for trades, whether based off charts, opening range, or otherwise. Things tend to move a little bit funky on OPEX week. So just something to take into consideration to contextualize, you know, why we might see a bit more chop, why we might see some of these strategies not play out as well as they may on other days. Now let's look at the Russell. I'm quite certain it showed the same pattern. Yep. Pretty violent gap down too. There's like no volume on that gap down in the Russell. So again, you get into the event, liquidity disappears ahead of time. The event happens. You have this giant gappy move, right? Lots of smaller stops probably stopped out on that. And then look, the gap gets like basically filled and then you move above. So, you know, it wasn't the wrong call necessarily to be long into it on the Russell. But if you had decent risk management, you probably got stopped out. Although, honestly, if you had decent risk management, you probably weren't trading this binary event. You're waiting for the reaction. So the last one I wanted to look at was 10 years, because this is such a crazy contract, right? Like, look at how much order book liquidity is on this thing. It's a depth of over 900,000 contracts. So I think that's pretty important to take into consideration, that even on something this crucial, this huge, what happened ahead of the event? All the liquidity disappeared, right? And then you had this exhaustive selling that my beta indicator caught. This is very, very early stage. So it is available on the TraderAid Discord. It's going to stay exclusively there, but it is an indicator that I'm working on for pretty much every futures instrument, and then eventually some equities and ETFs, to show instances of exhaustive selling and buying. And it did work pretty well for this exhaustion on the 10-year note. And guess what? Gap got filled, and when liquidity came back, we pushed higher, and now we're ignoring that hotter than expected PPI completely. Rates are going down, equities are going up. So just when you're trading these type of binary events, going into them, be careful. If you want to trade them, it's usually a decent strategy to have a wider stop and a smaller position so you can handle the volatility, right? If you're going to trade them at all. If you're newer to this game, best bet is not to trade them. You need to kind of get your sea legs first before you start going out there and doing the more aggressive type of stuff like this that has higher risk. Now, obviously, if you're in a swing trade, that's a little different. I'm more referring to folks that are short time frame, scalping or day trading or otherwise, right? That's where something like this could hurt a lot if you're on the wrong side of it. And I'm sure there's some folks listening that have either already been hurt by one of these types of event trades or just got hurt today. So there's no shame in not trading it if it's not your thing, right? These moves shake a lot of folks out. So just my 2 cents on that. So let's go back to S&P futures here. We can talk a little bit more about what's on screen, what it means. My buddy Podcast asked to break that down, and I would love nothing more than do just that. So first, the main screen here is the heat map. Okay, so if you haven't used Bookmap before, what you're seeing on screen is an illustration of where there have been in the past and are in the present resting offers and resting bids. So this white line is a mark that indicates that anything to the right of it is what's on offer now or what's being bid now. Anything behind it is the past. So we can see that whole time frame of where liquidity has been, where it disappeared, and where it came back. Why does this matter? Because the market is a three-way auction, and you're always trying to get a better understanding of whether we're in a period of excess demand, excess supply, or balance, right? I know there's a popular theory that it's a two-way auction. I think it's a three-way auction because there's always the opportunity for balance between demand and supply. So that's my own take, and Bookmap helps me to get a better feel for that with both how it's built and then some of the indicators I added to it. So outside of the heat map that we can see on screen, we also have these indicators that show us icebergs and stops. These ones that look more like diamonds with a little split in the middle, they're icebergs, and they're color-coded as to whether they're buys or sells. So what's an iceberg, you might ask? This is a really interesting question because there's a lot of misinformation about what icebergs are. I see a lot of folks talking about them just kind of looking at the volume profile and inferring something as an iceberg. That's really not an accurate way to look at it because we don't know whether that was an iceberg without knowing how the order was placed. So what is an actual iceberg? An iceberg is an order that is placed when you don't want to show your total size. Okay, so let's say you have like 10,000 shares of something you want to get out of, but you know that if you show that size, you're going to have folks running away from your order. So what do? Well, an iceberg order allows you to show the size that doesn't scare the order book away from your price. So maybe you show 500 and you do 20 lots of that, right? So you get through your 10,000 shares. Well, the advantage of doing an iceberg order is you have a little bit of stealth, right? You're able to get out of that order without showing the market your hand. This is especially useful for larger players, and we see it in futures all the time, but we see it in stocks as well. It's a little harder to map out in stocks than it is in futures because in futures, we've got rhythmic data that actually shows us when these orders are being placed, which is extraordinarily helpful. So what's the disadvantage of placing an iceberg? Well, if you don't have extreme priority at your broker, like if you aren't a super duper important client, then typically what's going to happen is after that first block, like we talked about shares. So let's say that first 500 shares is cleared, then whatever order is next in line gets cleared before you. Like you get pushed to the back of the line again, right? So all those orders that were ahead of you, they get filled first. So the disadvantage of an iceberg, at least for us folks that aren't super duper connected, is that you're going to not necessarily get the speed of the fill. And if price is moving all over the place, you may not get your whole fill. So there are advantages and there are disadvantages to these iceberg orders. But the reason I mention it is because an iceberg is very specifically a passive order. It's a passive sell or a passive buy. They know what their size is. Their broker or clearinghouse knows what their size is. The market doesn't really know until the order is cleared, assuming you have the data that even shows that, right? So why is that important? Because those are larger players that can come in and absorb selling or buying pressure, and sometimes that leads to reversal in price. So large enough icebergs, and it's all sort of contextual, right? Like if we have an order book size of a depth of 53,000, then I'm looking for icebergs of 1,000 plus to get my attention. Like pre-market, obviously 100 here, 100 there. That's interesting enough. But during the cash session, I'm really looking for 4-digit icebergs on the S&P contract. Now, the NASDAQ contract, quite a bit smaller, right? 2.9 thousand on offer, 4.3 thousand on bid. So for that, I'm only looking for 3-digit icebergs, mid 3-digit icebergs to catch my attention. But going back to the S&P, let's talk about some of these other lines on the screen. So we have up here the highest price level. You can see the label. This resets at 9:30 a.m. We have here the point of control. This is a balance of basically where the most transacting has happened, and it ends up being a very important area because buyers sort of take control of momentum above that point of control. Sellers take control below that point of control. And you can see that really aggressive buy delta around there. So if we moved further below that point of control, that would mean a lot of these orders that were placed, you can see that under the session volume profile. That's all the orders during this session. If those folks get off sides, that means they're more likely to be motivated sellers of those positions, even stopped out of them. Now, below the point of control, we've got VWAP. VWAP is this white line, and it's based off of this session, the current session. And then we have the lowest price level. That also resets at 9:30 a.m. That way we can very easily visualize the opening ranges. So that's all the lines on the main screen. Then we're going to start to get to some of these other areas. But first, we'll talk about some of the other indicators. So we've got these delta volume bars and delta bubbles, right? The delta bubbles and bars are showing you the difference between buying and selling. They are not just pure volume. They're showing you the difference. That's how I have mine set up, because I find that valuable. You get a sense of aggression. You get a sense of absorption at a glance. It's one of the most valuable indicators that they have. And I know for some folks it's a little confusing because it's not a candlestick. It doesn't look like a normal chart. But believe me, once you get used to it, understanding that these are like, this is a bit more aggressive buying. This is a bit more aggressive buying. This is less aggressive selling. Being able to see that at a glance is extremely helpful. For me, it's been a bit of a game changer, especially when you add in all the other elements on screen. Now let's talk about these numbers here, okay? This is the order book depth at present. This is where it was prior, right? And you can see there's an excess of bids versus offers of 6.2 thousand, right? That's across the entire order book. So this is a pretty decent order book, 54,000 ahead of the market open on order book depth. And then we have the subchart here. Let's talk about the subchart. That's this whole lower section. The green line here is cumulative volume delta. That is showing you the amount of buying during the session or the amount of selling during the session in excess of the other, right? So it's another delta. Right now, that's showing you 5,600 contracts bought in excess of sold. That buyers are just a little bit more aggressive here, particularly post PPI. We also see icebergs initially were sort of fading some of that early strength, and now they're starting to passively nibble just a little bit. The iceberg is a cumulative indicator that is on a rolling 30-minute time frame, just like the stops on this red line. So that means for about the period of time that I like to keep on my chart, which is about 30 minutes, that's about what these bottom areas on the chart are going to indicate in terms of the flow, except for the cumulative volume delta. Then we have this whole column on the right, and we'll talk about liquidity differential as well. That's just the total order book liquidity. Right now, there's about a 9% excess of buyers versus sellers across the whole order book, the way that I look at the differential. So let's talk about this right-hand area. Obviously, this column is price. COB is the current order book. That means everything above the current price are offers. Those are all in red, right? These are all resting offers. You can see them in the heat map, and you can see them in the current order book. It just gives you another way of visualizing that data. You can see there's a rather large offer that just came in around 52.60, and I have my labels set up so any of these offers in excess of 249, so 250 and up, will be labeled up to 5 at a time. And we do see a little bit of a death cloud above. There's just a lot of supply above us. So what does that tell us? It means buyers need to show they have the demand to push through this. Now, anything can change after the bell, but that's just where we are about 6 minutes ahead of the bell. Then we have the session volume profile, right? This shows you where there's been deltas of transacting during the session. So you can see buyers are really aggressive here. Those are those green bump outs. They were the most aggressive right around the point of control, which is why the point of control is so important, because we could see that if we push below that based on that delta, there'd be a lot of buyers off sides, like 1,300 contracts in just that area. So I think that's all pretty interesting. That's all the stuff that is built into Bookmap and some of the add-ons that are part of Bookmap's marketplace. Then we also have the advanced SPX options visualizer, which I built for Bookmap and shows you some of these key options positioning levels that may impact price discovery. The call wall above us, this correlates to 5,300 S&P. index, S&P 500 index. That's translated to ES levels for your convenience. Then we've got gamma 1. That's the largest level of total gamma positioning outside of the vol trigger level. We've got the gamma flip level, which is just around the vol trigger as well, which makes a lot of sense. There's a huge amount of positioning around 5,200 for what it's worth. So if we did crack 5,200, it's a vol trigger for two reasons. We'd go back into negative gamma, and you'd have a lot of changing in options positioning that could increase volatility, right? Then we also have these areas that show the most active calls and puts, called the hot call, which is the most active call, followed by the volume. The hot put, which is the most active put, followed by the volume, and the warm call and put are the second most active, followed by the volume. And you'll see a plus sign or an asterisk by either the hot put or the hot call. The plus sign means that that option is the most active on the chain, but it doesn't mean that calls are more active than puts in aggregate. If there's an asterisk there, it does. It means that calls are more active than puts in aggregate. So that's kind of how we read what's on screen with Bookmap. So I'm going to take a stop here. If anyone has any questions, let me know. And someone asks in the YouTube chat, do you have any recommendations on a good futures broker and trading platform? I like interactive brokers for futures personally. I know people have different experiences. EdgeClear is also, I've heard, is pretty decent. So those would be the two that I'd probably look at. But, you know, that's just based on interactive brokers I have experience with. EdgeClear, I've just heard good things about. So, you know, your mileage may vary. If you're going to go with any kind of broker, you got to make sure you get a decent source of data as well. So just kind of be mindful of that, you know, that you're going to have to pay for your data feed. That interactive brokers and EdgeClear and others don't typically give you full futures data. So you usually want to have a charting platform that gives you everything. Rhythmic tends to be the best source of futures data from my experience, because interactive brokers and others, they tend to sort of compartmentalize and compress the data so you don't get all of the volume footprint, you don't get all the transactional activity, and it can lead to some pretty funky looking volume profile charts that don't match up what's actually happening in the market. So just another bit of context there that may help. So what I like to do is I use Bookmap, I use TradingView, I use MotiveWave. Those are my three favorite charting platforms. And then someone asks, what level corresponds with Bookmap to purchase that has all these features? So you can get Global Plus. If I recall correctly, that comes with some of the add-ons, but the S&P options visualizer is separate and Rhythmic data is separate, right? So you buy your base Bookmap package and it comes with some of the add-ons if you get like the Global Plus, but then you need to get your data package. I prefer Rhythmic over DX feed. Because Rhythmic has the ability to look at stops and icebergs. And then I prefer, you know, adding on the, I'd be talking my own book here, obviously, but I created the advanced SPX options visualizer because it was originally really for me because I saw value in being able to visualize this data. Then I made it available on the TraderA Discord and continue to tweak it and build it and improve the algorithm. And eventually I made it available on the Bookmap marketplace because I felt it was at a production level. And so for me, that's the whole package. Hopefully that helps. Let me know if you have any questions. Do you have a session on futures trading for small account players with a cash account and no margin? I mean, it depends on the size of the account. How small is small? You know, these futures contracts have pretty big margin requirements. You're going to be trading with margin. Like when you're trading futures, pretty much no matter what, you're going to be trading with margin. If you're going to do cash covered futures trading, you're going to have like hundreds of thousands of dollars in your account. So like if you're saying $2,000, you're not going to be able to trade futures without margin. Even the micros are going to require margin. That doesn't mean you can't trade them. It just means you have to appreciate the risk involved with what you're trading. And with a smaller account, you're going to have to be quite careful with how you grow that account and how you manage your risk. If you connect your IBKR to a Bookmap, do you need market data from IBKR? Yes, you do. Because, I mean, look, you could probably try to blindly trade on IBKR without market data, but it's going to be frustrating. And you're probably going to... I'm just going to imagine that your execution is not going to be as good. You do want to have the data in IBKR, and they have their own data packages. They don't, as far as I know, they don't offer Rhythmic. So yeah, I would be mindful of having, you know, data for your charting and data for your broker. Now, Bookmap has its own trading capabilities built in, but I'm going to tell you that right now I have not explored those capabilities to such an extent that I can say, you know, that's how I would trade. I have not used Bookmap for my trading. I place my trading directly through my broker. I actually have hotkeys set up on my keyboard to make it very easy to get in and out of things. For me, for some folks that can get them in trouble. So don't necessarily do that unless you have the discipline. But for me, it's been helpful to get the speed of execution that I sometimes need. So market is opening here. So we see just a bit of a reset. I reset, you know, kind of everything at the market open. So cumulative volume delta gets reset. High-low pricing gets reset. So we kind of get to really get a sense as to what all is happening from the cash session open. Someone asks, do I place
Large
orders?
bid imbalance of 22% in IMC at the X-feed order book.
Ooh, crazy
Large
stuff
bid
happening
imbalance
in
of 20%
AMC.
in IMC at the X-feed order book. Large bid imbalance of
turn that off
20% in IMC at the X-feed order book.
Because that's not what we need alerts for. But yeah, AMD taking a bit of a pull here from its highs. Not terribly surprising to see that, but nevertheless, that's what that alert was about. Pretty crazy moves on this stock, though. If you zoom out, it's just been all over the map. And I am one to say that I'm not a huge fan of these because these squeezes typically are a bit ominous. You could see a bit of buyer exhaustion up there as one of the signals, too. So, you know, it is starting to work okay for stocks. I've still got some tuning to do, though. So someone asks again, do I place orders using normal entry, the DOM, or charts? Tony, that's a good question. I do tend to use hotkeys for the most part. I also, but that's mostly for day trading, right? So let's just zoom out to swing trading. For swing trading, I tend to put brackets on and just walk away. You know, I'll usually use a hard stop or a trail stop, and I'll have some kind of exit target for my core. So that's a little different than the hotkeys. Those are the two ways I tend to place orders in IBKR. Do I still see an NVIDIA 940 call sweep for Friday? That was a sweep that happened the other day. So it happened. It's already in the books. Whether NVIDIA hits that price on Friday is a whole other matter altogether. You're just seeing people kind of placing their bets, right? They're expressing their opinions through the options market. And seeing that overhead offer at 52.60, just growing a little bit to 438, just a huge amount of liquidity overhead. It does look a smidge death cloudy. Sometimes when there's just an enormous amount of offered liquidity overhead, it can get the buyers a little timid. They have to show they have enough supply to push through all of these contracts. And that's not necessarily a super easy task. So we're going to be keeping an eye on that liquidity and how it takes shape through the trading day here. Let's look at some of the meme stocks, though. I can't help but to have a morbid fascination with what all is happening here. GameStop just dropping off a cliff. My God. No real liquidity here either. Like, no volume on this drop. It's just dropping. And now it's halted. So that's interesting. Same look in AMC, big drop and a halt. I mean, you know, folks, I don't know if any of you all listening are playing these things. If you've made money in them, that's awesome, but please be careful. A lot of people get hurt really bad on these things. There's some folks that were like holding them for years and years and years, hoping for something like this to happen, but then they don't necessarily see this as being like a very ephemeral event, what short squeezes are. Short squeezes are not something that tends to last, and the dynamics in these stocks are a lot different now than they were then. The short interest is a lot lower, so you're not going to necessarily get the same kind of moves. Like I know GameStop went from $5 to 100 something last time. I would be careful to think it's going to go from like 20 to, you know, hundreds and hundreds of dollars this time, especially with much lower short interest. And this is all being driven by like someone who we think might be Keith Gill. We don't know. He hasn't posted on any of the other social channels yet. And he's just not even referenced any stock. And he's just posted like a picture in some movies. And this is the impetus for these moves. Just be careful out there, folks. This is a lot different than what we had happen last time in so many different ways. I just don't want to see people get hurt. I'm all in favor of people making money. I think it's awesome when people are able to, you know, take some money from the hedge funds, and we know they're massively short a lot of these stocks. But on the other side of it, these short squeezes tend to unravel pretty quickly, and a lot of people get in too late, and then they just end up holding these things for a very long time. Someone said, heard billions of daily bids at VWAP until June, so guessing bullish until summer. I mean, I don't have that kind of foresight to know that there's going to be billions of bids at VWAP into June. I mean, I don't know that anyone does. If we see that, certainly it portends to more bullish kind of defense of price, but I would contextualize this a little differently and say, you know, what we should really focus on is the market in front of us, not narratives, not what people say, not people claiming to share privileged or inside information or insights, because a lot of those folks that kind of try to predict, you know, I hate to say it, but often is the case, they're just making things up as they go to get engagement. The market is a game of probabilities. It's about modeling for probabilistic outcomes and trying to be on the right side of those probabilities as often as you can, building a system that helps you stay on the right side of those probabilities and keeping it honest. Yeah, there's certainly corporate buybacks that are happening, and they're passive buyers mostly on dips. But in terms of exactly how and where that plays out and what the implications are for the broader market, we can't make strong inferences about that. Yep, so you have different players in the market. You've got share buybacks, you've got CTA, systematic vol managers, you've got active money managers and different types of funds that are participants. The issue is, you know, if people could reliably model this stuff in advance and know with certainty what's going to happen, then there would be no reason to share that data with anyone. They would just use it to gain an outsized advantage and trade their own book against it. So the fact that data is out there in the public and the fact that it's, you know, got a hit rate of maybe 55% tells you everything you need to know. So far, not much of an opening range here. Maybe we'll have a little bit more volatility over the next 11 minutes or so as we establish that 20-minute opening range that I like to look at. But so far, this is a pretty sideways tape. Let's look at some of the other markets here. Russell, a little bit more exciting. Seeing some selling pressure there. NASDAQ seeing just a little bit more volatility in the S&P, moving the opposite way as the Russell, a little bit higher there. Rates coming down, or I'm sorry, price of the 10-year note futures coming down a bit. Rates moving up just a little bit over the last 15 minutes. Maybe that's one of the reasons the Russell's getting some pressure. And crude oil has been kind of a choppy trade. We did see some exhaustive selling here. We got a bit of a bid off that. Now we're starting to move higher. But I would say crude is one that I'm not super interested in trading the futures contract itself as a swing unless it moves above 81. Then I would want to get long. For now, it's just much more of a day trading vehicle as it sort of finds its legs one way or the other. And gold is looking pretty interesting. You do see a bit of a buy program below us here. It was started a ways back, this iceberg that hasn't fully executed. Just on that sell down we had post PPI. So that got some of the sellers a little bit more concerned. We've seen a bit of a push higher from there. Going back to the S&P here, kind of challenging the top of this range. We're going to zoom in just a little bit. Order book liquidity remains pretty decent. But so far we basically have about a 6-handle opening range, which is a bit uninspiring for the first 10 minutes of trading. And now we're finally seeing some buying here as we push higher out of that 10-minute opening range. You see a bit of a stop out of some of these smaller traders, 291 buy stops there. You can see that on the sub chart. You can also see it on the radial. There is a bit more conviction coming into that buying. You can see those are the largest buying delta bubbles we've seen in about the last 10 minutes. So when we're looking at, because I got a question about the Fed and sort of what the expectation is with regards to their cuts. So there is still some chance they're going to cut this year. There's still reasonable pricing. Let me just go ahead and do the math here because I want to make sure I give you guys accurate info. So 94. Let's see. So they're still pricing in 35 bips of cuts this year. If we look at Fed funds futures, it's basically pricing in 1.5 cuts, probably to start in September or November. Okay, so that's it was last year in December, they were pricing in 7 cuts. Now we're pricing in 1.5 in 2024, and then, you know, maybe another 1 or 2 in 2025. Now, I think we kind of need to ask ourselves a couple of questions about this. One of them is, you know, if you think about what happened in 2023, the market rallied in the face of rates being high and, you know, kind of the tail end of that aggressive Fed hiking cycle. And does that mean the Fed doesn't matter? Or does that mean something else overwhelmed monetary policy? I would argue that it was the latter, that fiscal excess overwhelmed monetary policy. And as a result, the Fed's policies didn't really work. They didn't really exude the effect that they wanted to get at some of that excess out of the system. So on the other side of that, does that necessarily mean a Fed cutting cycle will be bullish for stocks? It may not be. It all depends on what the context is. If inflation is elevated, the bond market very well may fight the Fed and do the work of the Fed for them. So I would just be mindful of that in terms of, like, you know, the context of what happens when the Fed cuts or if it cuts. I think that this is a market that's driven much more by fiscal excess than anything in monetary policy, for one. And also it's a market that's been led by, you know, impressive revenue and earnings growth by a cadre of like basically 4 or 5 stocks, these very large mega cap stocks. So as long as those themes are in place, you know, I'm not so sure that the Fed's policy is going to matter that much, unfortunately. I know that it has an effect on animal spirits and on interest rates, and there's some peripheral impacts on equities. But I think this has more to do with the surplus of liquidity and real growth happening, but in a small subset of stocks. Now, those growth rates are likely to be challenged moving forward. I don't think we can keep growing those 5 or 6 or 4 or 5 stocks at the same rates they'd previously enjoyed. I find that to be highly unlikely. But we'll see. And the other burden of proof here is, you know, do the inglorious 493 sort of pick up the reins from here? And do they start growing and outpacing those really large stocks? It's possible. That would be part of that rotation into some of the older economy stocks we've been talking about since the beginning of the year. That's been a pretty profitable trade. Is there something called VWAP time? No. I mean, VWAP is just volume weighted average price. So it's just a line that is drawn on the screen based on time and volume weighting of the average price over that same time, right? So it's not necessarily an implied certainty to anything. It's just an area to look at and get a sense as to who's in control. So I put the VWAP on screen to show, you know, just another metric above the point of control to give us a sense as to who's in control. So we could see when we pushed above the point of control and VWAP, we really started to get a more robust bid. So for me, it's just helpful to contextualize who has control of the tape. You're welcome. All right, let's take a look at some of these other parts of the market here. We've got the NASDAQ on screen really outpacing the S&P, catching a pretty strong bid in the NASDAQ so far. You did also have just a little bit of a iceberg buy come in here. That seems to have helped to spark some of that buying pressure. You saw the NASDAQ break above the point of control in VWAP, retested, but after the open had a more decisive break. So the NASDAQ tends to be the momentum leader in this market. When it moves, it tends to pull the S&P higher. So this is pretty encouraging for bulls to see this kind of a move in the NASDAQ. You've also got a large resting offer overhead at 18,350. So this can be a bit of a magnet for price. You see that there's interest in price above, and it's not overwhelming interest. It's a lot different than what we see in the S&P, where you've got a very large amount of interest in buyers just sort of shying away from it, at least for now. Let's take a look at our favorite meme stocks. GameStop is trading again, but it's had 3 halts so far today. And the stock is trading, well, it's not doing so hot. It is up, but it is well off of its earlier highs. Let's take a look at AMC. Similar look here. It's had 2 halts. Now it's on its 3rd. After that drop. So a lot of that pre-market gain being cut out. And, you know, it's a lot easier to pump something pre-market than it is during the cash session. And yeah, when someone mentions that the VIX is moving up with the market, what that typically tells you is that there's a bit of euphoria, because the VIX is not a fear measure. It is a measure of forward-looking price uncertainty. right? And when the VIX moves up, when the market moves up, what that really tells you is there's a lot of call buying in SPX calls. And that's exactly what we're seeing. There's an excess of 15% in the put call ratio on SPX in favor of calls versus puts. So that's exactly why the VIX is moving up. There's call buying in SPX. It's also a poorly hedged market. There hasn't been much demand for puts. So, you know, going back, when you see the market move up with the VIX, if that continues to happen, it's generally not a good sign. So just something to take into consideration. I also just going to get on my soapbox for a minute and say that for the most part, the VIX has become pretty useless as a measure of market hedging. It's much more important to look at things like skew, positioning in futures, ETFs, single stocks, and otherwise, than to look at the VIX itself. The VIX itself is so suppressed from vol selling and near-dated options trading because more and more people are expressing their opinion near to the money, closer to expiration. So it's not even showing up in the VIX, right? And there's also, by definition of more near-dated options trading closer to the money, less future price uncertainty. Does the VIX options market push
So in
VIX
10 minutes
around
time now, at
significantly?
the top of the hour, do get the headline event for the day, which is comments from Fed's Powell, speaking at a special event organised by Netherlands Foreign Bankers Association. No text is expected for Powell, but there will be a Q&A with the moderator.
Should be kind of a boring Powell speech. I don't expect much from it, but you know, so someone asked, does the VIX options market push VIX around significantly to the degree that, say, SPX options do? No. It's much more about SPX options than VIX options. It can move it, especially in the absence of a lot of S&P options, but it's really going to be S&P options because the VIX is just the measure of implied volatility for the S&P index. That's really all it is. So, you know, you get IVOL in single stocks. VIX is the IVOL for the S&P.
We have got the link to Fed's Powell speaking pinned on his entry in the calendar for anybody interested. I will also post it out on the feed momentarily.
Let's take a look at the 10-year. Not really doing much here, just chopping sideways. You did see some pretty good absorption below. About 2,000 contracts for 10-year note futures bought recently. Very narrow price range. And the euro, the anti-dollar, getting a pretty big bid after PPI. Not exactly what you would expect, but because rates are dropping, so too is the dollar, not looking too hot here. Well, let's go back to the S&P here now that we have our 20-minute opening range, and boy, is it an uninspiring one again. This is about a 9-handle opening range. So, you know, you might get a 4.5 handle 50% extension, or a, you know, a 9-handle 100% extension, something like that, somewhere in between. But this typically doesn't portend to a very exciting trading day. So just something to take into context. Now, obviously, it is OPEX week, so some of those, you know, some of those correlations, some of those probabilistic outcomes are not necessarily going to be as strong, but still something to keep an eye on. And it is kind of odd, by the way, to get that kind of a bid in the euro and the 10-year note after a PPI that was not ideal. It came in quite a bit hotter than expected. Final services came in the hottest, I want to say, since I think it was July 2023. Nevertheless, markets are happy to discount it for now. Tomorrow we get CPI. Maybe they know something we don't. Maybe they don't. But whatever the case may be, going into that and going into today, these markets were not particularly well hedged. Skew remains pretty darn low versus positioning. Positioning has come back up. It's really bullish on a number of different measures. People are very, very excited about upward pricing potential. But on the other side, they're not very concerned about any kind of left tail risk. So they're not hedged for anything that might happen. And that means if CPI did come in materially hotter than expected, there could be some more de-risking. I could see the market overlooking PPI. It often doesn't give it too much value, but CPI is a different matter altogether. Also, I started talking about orange juice potentially breaking out. I think that was last week, and boy, is it breaking out. It's continuing today. It's up to 416.30. up about another 3% on OJ. Just interesting to see how some of these ags are running. We've seen wheat running really hard recently. Corn's come back, soy's come back. Obviously a lot of these metals like copper, palladium, platinum, especially gold and silver. There's a lot of things that are running. There's a lot of things that are moving in the commodities world that suggests that the sort of inflationary pressure may not be quite over yet. And we're seeing that in PPI, but we're seeing that in a number of different measures. And we just got consumer inflation expectations yesterday. They came in higher than expected as well. And we saw that in UOM consumer sentiment last week, or conference board. The biggest reason that it dropped most of these sentiment readings, it was UOM, but the biggest reason it dropped was inflation concerns, right? So just be aware that folks are becoming more concerned about that inflation that may impact spending, which may in turn impact earnings and economic activity. Yeah, Powell speaking at 10 a.m. It's a graduation event or some kind of educational type of event. I don't expect it to be a huge market mover, but we'll see.
So in 5 minutes time now at the top of the hour, we're expecting comments from Fed's Powell and ECB's Not, who again are speaking at an event organized by the Netherlands Foreign Bankers Association. No text expected, but there is a Q&A. Live video is on the feed and pinned to Powell's entry in the calendar for anyone interested.
All right, folks, I've got about 4 minutes left. Okay, so correction on Powell. He's due to speak on the Netherlands Foreign Bankers Association event in Amsterdam, and audience questions are expected. So I'm going to hop off of the Bookmap stream at 10 a.m. because they've got some other things going on, some other folks that will be presenting. So always be sure to check out the content they have. They rock. But I will live stream the Powell event on my stream on Twitter and YouTube and Twitch for folks that want to tune in. And I'll just kind of put it into Bookmap so you can still see the price action, but we'll be able to see the big man talking as well and what kind of price discovery it may have. Amazon's Adam Selipsky is going to step down as AWS CEO. This headline just breaking. So, folks, I hope you enjoyed the stream. Really appreciate you all tuning in. If you enjoyed what Bookmap can do for you to see the markets, you can always get a pretty decent discount, up to 40%. Visit TraderA.com/bookmap. That's TraderA.com/bookmap.
Kazakhstan has requested a higher level of oil production from OPEC Plus.
And if you're interested in Trader Aid and what we do to help educate, and we also have an amazing community. We've got some great trading tools and some banger ideas that we share regularly. Check out TraderAid.com. You can sign up with a 20% discount for a limited time using the code Mayhem20 at checkout. If you want to check out the SPX Advanced Options Visualizer, you can just visit TraderAid.com/SPX to learn more about it. And if you're a longer-term investor or want to learn more about longer-term investing and strategies, check out Macrovisor.com. And folks, in between my Bookmap streams, if you have any questions for me about what I'm doing on Bookmap, how I'm using it, or otherwise, feel free to reach out. You can shoot me an email, mayhem@TraderAid.com. I love hearing from folks. I like helping. You can also reply to me on Twitter, although I'll be honest, I can't always get back to all my replies, all my emails, all my messages, but I do try my best. Yeah, you're welcome. Thank you all so much for tuning in. I really appreciate it. I have a lot of fun doing these. For me, I mean, it's just really like why I started doing what I was doing in social media was to both learn and share. And we're always going to be students of the market, no matter how good we are. I've been trading this market for 19 years. I'm still learning new things every day. And you have to. The world of finance keeps evolving. That's why I mentioned, the VIX is not a good indicator for hedging. Maybe it used to be. It's not anymore. It's another perfect way to illustrate why you have to keep adapting and evolving. You can't stay stagnant or the market will leave you behind. So thank you so much, everyone, for tuning in. This has been me, Markets and Mayhem. Back to the futures. We'll be continuing on outside of the Bookmap Discord and YouTube on my YouTube and Twitter and Twitch streams. So if you'd like to tune in, please do. But also check out Bookmap and what they're doing on their Discord and their YouTube. They share great content. They've got a lot of great videos telling you more about how the platform works. So highly recommend checking them out. Talk to you all soon.